Hello, we are here working problem 12 from exam 1A that we took fall of 2015, and problem 12 asks us to do a retained earnings statement. So retained earnings statement is nothing more than calculating the retained earnings at the end of the year. So you have to start with your beginning retained earnings, add in any income you earned, subtract any dividends you paid out, and then you end up with your end of the year retained earnings. Makes sense, pretty simple. The only thing about this particular problem is there's information we don't need. So let's take a look at it. It tells us we're doing our December 31st, 2014. So the year ending is December 31st, 2014. The beginning retained earnings were $250,000. All right, so we know we need that. We started out on the first day of the year with $250,000. We know we need to add net income. Here it is, net income for 2014, so we need to add that. And we know we need to subtract out dividends, so we'll subtract that out. But some of these we don't need, right? Cash does not go on the statement of retained earnings. Cash is an asset. It goes on the balance sheet and only the balance sheet, never anywhere else. Accounts payable, that's a liability. It goes on the balance sheet and only the balance sheet, never anywhere else. So we've got what we need: beginning retained earnings, net income that came in, minus dividends that came out. We're ready to calculate the increase of retained earnings and our new retained earnings. So I've written up a typical heading, right? The company we're doing the books for, what statement we're doing, and the period. So for the year ending December 31st, 2014. So the first thing is you start with your original retained earnings. So January 1 had $250,000. I'm going to abbreviate a little bit. Retained earnings January 1, 2014 is $250,000. All right, so there's that. We know we add net income, right? So $350,000. So we're going to say $350,000. Then we deduct dividends we paid out, which are $250,000. $350 minus $250 gives us increase in retained earnings, right? I suppose it's possible a company doesn't pay them out, so the increase is simply net earnings. Or it's possible you had a net loss, so you could actually have to subtract from your retained earnings. But in this case, we had income and we had dividends. So you add the dividends, you add the net income, subtract the dividends, you come up with your increase, which is $100,000, right? So $250 plus $100,000 means my retained earnings for December 31st (2014) are $350,000. That's it. Pretty basic and simple. Good luck with doing retained earnings statements. I'm sure there will be one on the final.